Something historic just happened in India's stock market, and most headlines missed why it matters. For decades, foreign investors were the single most important force setting the direction of Indian shares. When they bought, the market rose. When they sold, it fell. They were the marginal buyer, the hand on the steering wheel. In 2026, that hand let go. Foreign investors have pulled out record sums, and for the first time, their ownership of Indian equities has slipped below that of domestic institutions. The people who used to run this market are now, quietly, in second place. This is the story of how the ownership of India's market changed hands, and why it changes the way the whole market behaves. Here is why this matters to anyone watching Indian stocks. By the first week of May 2026, foreign portfolio investors had pulled about 1.92 lakh crore rupees out of Indian equities. That single stretch already beat the 1.66 lakh crore they withdrew across the whole of 2025. A flood of selling like that would normally crater a market. But Indian indices did not collapse. The reason is the other side of the trade. Domestic institutions, the mutual funds and insurers funded by ordinary Indians putting money in every month, stepped in and absorbed the selling. That handoff from foreign sellers to domestic buyers is the most important structural story in Indian markets right now. It explains why the market held up, and it quietly rewires who is in control. So why are foreigners leaving? It is not one reason. It is a stack of them arriving together. First, the rupee. It has weakened sharply against the dollar, and for a foreign investor, a falling rupee silently eats their returns, which we will come back to. Second, global fear. A conflict in West Asia and worries about tariffs pushed big institutional money back toward the perceived safety of the US dollar and American assets. Third, valuation. Indian stocks had become expensive relative to other markets, so when money looked for somewhere to hide, India was an easy place to take profits. Stack those together and you get a steady, months-long withdrawal. April alone saw more than 60,000 crore rupees leave. The question is what that does to the machinery of the market itself. Here is the mechanism, and it is a loop. Imagine you are a fund in New York holding Indian shares. Your returns have two parts: how the stock does in rupees and what the rupee is worth in dollars when you convert back. If the Nifty rises 12%, but the rupee falls 6% against the dollar, your actual dollar return is only around 6%. The currency quietly halved your gain. Now flip it. When the rupee is falling, foreign investors rush to sell before it falls further. But to leave India, they sell rupees and buy dollars, which pushes the rupee down even more, which makes the next foreign investor even more eager to leave. Selling causes the very weakness that triggers more selling. That is a feedback loop, and it is why outflows, once they start, tend to come in waves rather than trickles. Now step back, because the handoff creates two different kinds of market. In the old regime, foreign money was the marginal buyer. That money is fast, global, and reacts to the dollar, US interest rates, and world events. So Indian stocks often danced to a foreign tune, calm when global money was confident, violent when it fled. In the new regime, domestic institutions are the dominant owners. That money behaves differently. It arrives in steady monthly installments from local savers and tends to buy dips rather than chase panic. A market anchored by patient domestic money can be more stable when foreigners sell, because there is a committed buyer underneath. But it also means valuations can stay high even when global investors think India is expensive, because the local bid does not leave. Same market, two different sets of rules, depending on whose money is in charge. This is not a small shift. It is a record. Foreign ownership of Indian equities has fallen to roughly 16%, the lowest in nearly 2 decades, and for the first time it sits below domestic institutional ownership. Think about what that means. The group that for a generation decided whether India's market rose or fell is now the smaller owner. The people who got hurt in the short run were foreigners who sold near a weak rupee and locked in currency losses. The quieter winners were domestic institutions who bought the shares the foreigners dumped. Whether that is good or bad depends on what happens next, but the structural fact is settled. Control of India's market has moved from abroad to at home, and that changes which shocks the market feels and which it now shrugs off. So what do you take from this? Not a trade and not a prediction. The lesson is a lens. The most important question about any market is who the marginal buyer is, because that is whose fears and habits the market inherits. For decades, India inherited the moods of global money. In 2026, it increasingly inherits the habits of domestic savers. That can make the market steadier when the world panics, but it can also keep prices high when foreigners think they should fall. None of this guarantees what happens next, and flows can reverse the moment the rupee stabilizes and global fear fades. The forward question is the interesting one. If foreigners come back to a market they no longer control, do they push it up, or do they find that the locals have already set the price? If breakdowns of the market's hidden machinery are useful to you, there are more here. This channel explains how markets work. It is educational, and it is not financial advice.